Welcome back to ETF.com University, where we demystify the world of ETFs. My name is Dave Nottig, Managing Director here at ETF.com, and today we're going to look at how ETFs trade. We're going to look at things like your order size and your time horizon, when to trade, who to trade with, and how to figure out how much all this stuff is actually costing you. We'll dive deep into what ETF liquidity even means, both on the screen and at the underlying level with what ETFs actually hold. Let's get started with an easy question, which is the who. And by that I mean, when you buy or sell an ETF, who are you actually trading with? It's not actually a trick question. There are several players in the ETF ecosystem that are part of your trade. First, there's you. You're the one actually making this trade. It's your money after all. And you've got some sort of a broker. Whether you're the smallest investor or the largest, there's some step between you and the actual market where your trades are going to happen. Then there's the exchange itself, which in the modern world is really just a giant pile of computers somewhere that matches up buyers and sellers. Those computers take your orders, but they also host the market makers who act as buyers and sellers often on the other side of that trade all day long, literally making the market for stocks and ETFs. And then some of those market makers are also the authorized participants that we talked about in the creation redemption video. Those are the folks who can actually work with issuers to make or get rid of ETF shares. So here you are, you want to buy $10,000 of some ETF. So how do you think about that ETF trade going in? I think part of the trading puzzle is really two pieces. The first part is what we often call liquidity. So that could include things like volume, that's the statistic we most likely see, but that's really just an indicator of how much people are trading that ETF. The more important issue is actually the spread. In every market for everything in the world, you're usually going to pay a little bit more to buy something than you would get if you sold it at exactly the same time. The difference between those two prices is the spread. And market makers don't get into the business just for fun. They get into the business to book that spread, to earn that spread, that constant difference between the buy and the sell. They know that they can sell for a penny or two more than they're buying at all day long. It's also why when you go to your brokerage window, you're going to see a bid, which is what you could sell your shares at into the market, and an ask, which is what you'd pay to buy brand new shares. You'll also see the last price, but that's just the last trade that got made in that ETF. If that ETF is really liquid, then that trade may just be a second or two old. But if it's less liquid, it could be an hour old, it could be a day old. And since markets are always moving, that stale last trade isn't very important. What's really important is that bid-ask price. That's the one that you should be paying attention to. Another consideration is just how many bids and asks are out there for a given ETF. That's what we call the depth of book. Now, generally, you're only going to see the very best bid and the very best ask on the screen, but there are usually lots of folks a penny or two further away from those prices. The last consideration in liquidity is really just a cost. It's how much you may have to pay to make that transaction happen. That could just be the commissions that you have to pay with your broker. Maybe that's cheap, maybe that's expensive, and really all that rolled together is what your personal liquidity is going to be. But then there's another issue, which is that price that you're going to pay a good price or a bad price? We're going to address both of those things. But first, I want to address the two biggest myths about ETF trading and why they're both a little bit right and a little bit wrong. The first myth is that you should never buy an ETF that's below some magical number, some threshold. I hear people kick around 100,000 shares all the time. The second myth is that doesn't matter at all, and you can always just trade an ETF because the underlying of the ETF is all that's matter. If those underlying stocks or bonds are super liquid, then you can just trade the ETF without thinking about it. There's really a little bit of truth to both of those, and there's also a little bit wrong with both of those. To try to explain that, I'm going to use a metaphor, and that metaphor is a volcano. So imagine that at any given point, there's some lava on the surface of the volcano that you can see. Now, it would be a mistake to think that that's all the lava that exists, because down under the surface, there's a whole bunch of magma at the core just waiting to come to the surface. Both are important. What's on top that you can see right now, that you could access right now, you could reach out and burn your fingers on the lava, and what's underneath the ground, which is going to bring new lava to the surface. They're both important, but neither one of them is a complete picture. Let's look at a few examples of some of that surface and some of that underlying liquidity. I have a folder on my computer where I store weird trades, both good trades and bad trades in ETFs. So for example, here we're looking at a truly massive trade made right at the bid-ask midpoint. And you can see it has no impact on the trades that follow it. Now, if you're not used to reading Bloomberg screens, that's 217,000 shares trading at $55 or about $11 million. They can push that huge trade through because they're not just dropping a 200,000 share trade into their Schwab account. They're working with an authorized participant who can create and deliver new shares at that price. They're tapping that underlying liquidity, that magma that's at the bottom of the volcano. Of course, it doesn't always work that perfectly. If you look at the surface liquidity and you don't work to get under the ground, you could get burnt if you were just unfortunate enough to dump that in as a market order. You can still get a terrible execution if you're not paying attention. So here's a fund that was trading all day around $50, and then all of a sudden one trade shot up to $55 a share, and then all the trades after that go back to being $50 a share. That's just a bad trade. The point here is that ETFs can bring you this incredible liquidity, but you need to do a little bit of homework first. It also highlights my first number one rule of thumb for trading ETFs, which is always use a limit order. A limit order simply says, I will buy this ETF for this price and no more, or I'll sell this for this price and no less. Clearly in this last trade, there wasn't a limit order in place. You can think about limit orders as being like the anti-lock brakes for ETF trading. It's not going to do all the work for you, but it's going to keep you out of trouble. One of the other key ways of staying out of trouble is to pay attention to when you're trading, not just what you're trading or how you're trading it. Timing really can be everything when it comes to trading. I love this chart because it shows me two things at once. It's super efficient. The first thing is this dark line here, which is the ETF. You can see it trading at a tighter spread than you might expect, given that if you looked at all the stocks it owns, that lighter line, you can see how wide those spreads are. The ETF is actually more efficient than what it owns all day long. But the second thing you can see is how those spreads change over the course of a trading day. First thing in the morning, some of the stocks that this ETF owns haven't even opened. They haven't even started trading yet, but the ETF started trading almost immediately. The market isn't 100% certain about what a good price is yet, so the market maker keeps the spreads quite wide until about half an hour into the trading day. And then, right at the end of the day, spreads open up again as people get nervous going into the close. And this is where my second sort of basic rule of thumb comes in for smaller investors, and that's don't trade the open and don't trade the close. It's not that you can't get good execution there, but you're entering into a market dominated by institutional traders and program trades, day traders who are really trying to make quick, fast calls about where the market's heading or where the market's going to end up. For most investors, that's not really what you're after. You're after exposure. So unless you've got a good reason, rule number 2, don't trade the open, don't trade the close. So that's 2 rules of thumb about the trades themselves. But how do you know that the prices that you're seeing on the screen are even fair? When we talked about creation redemption, we talked about how authorized participants step in to keep prices fair by arbitraging out differences between what's in the portfolio and what the ETF's trading at. But how do you as an investor know if that authorized participant's doing their job? How do you know that the system's working? Well, one way is through something called ENAV, or intraday net asset value. When we talk about fair value in ETFs, what we're really talking about is how well the price of a given fund aligns with the actual prices of its underlying holdings at any given point in time. Now, ENAV is published every 15 seconds, and for many funds, it aligns beautifully with the price all day long. Like here's SPY as an example, the S&P 500 SPDR, and the lines are so close you can barely tell a difference. That's the beauty of ENAV. It lets us know things are working. If, for example, the ETF was trading at a price above its ENAV, we would say the fund was trading at a premium. If it was trading below its sort of fair value, we would say it was trading at a discount. Now, not every ETF trades like this, but most ETFs, certainly those that own US equities or US bonds, do a pretty good job. But there are cases where intraday values that you can see on your brokerage screen are just going to be wrong. With something like SPY, it's trading all day long, second by second, at the same time everything it owns is trading all day long, second by second. So it's pretty trivial to just add up all the things that the fund owns and say this is what it's worth. But what about an ETF that's not holding just stocks trading at the same time? For example, if you were trading on an exchange in the US and buying a fund, but those underlying securities were all, say, on the London Stock Exchange, well, then between the hours of 9:30 Eastern and 11 Eastern, sure, all those stocks are trading in London at the same time the ETF is trading here in the US. In theory, that intraday net asset value, or ENAV, and the trading price should align pretty well. And what if you wanted to trade a fund where the underlying securities were all in Tokyo? Well, the Japanese market is closed at any given time the US market is open. So this ENAV calculation would be using completely stale prices. It's effectively useless. And that's not the only place things can go wrong. What happens if the exchange that the underlying security is on is just closed for the day, or maybe for a couple of days? Let's take a look at this example. This is the Spider S&P China ETF, GXC. You'll note here that in January 2012, it looks like GXC's ENAV is way different than the price people are trading the actual ETF at. And it jumps wildly sort of at the end of the day. So what's going on here? Well, there's nothing broken. It's just this was the beginning of the year of the dragon, and the Chinese markets were all closed for the New Year celebration. The fund didn't stop trading in New York. It just kept plugging along until the markets opened back up a few days later, and then we can see that the ENAV and the price come back in line quite nicely. Sometimes there's even a really good reason for a premium. In the Arab Spring, the price discovery that happened in the ETF replaced what happened when the markets in Egypt were actually closed. That price discovery is what happens when the trading price of an ETF becomes the proxy for all these underlying holdings which were no longer trading. Whether it's the Chinese New Year or political revolution, those things can affect the underlying markets, but they often don't affect the US trading ETF. The ETF becomes the market. So what's the rule of thumb to take away from all this? Well, a good start is just to understand this idea of market hours overlap. It's a stat you can actually find on every ETF.com fund page. If that stat says 100%, well, then that means that the ENAV and the trading time for the ETF overlap perfectly. And what do you do if that market hours overlap isn't 100%? Well, it just means there's something else going on here, and you should be skeptical of that ENAV. You'll have to trust a little bit that the market is accurately pricing that ETF. That can be a bit of a leap of faith, but for funds that trade a reasonable amount every day, history would suggest it's a leap worth taking. So where does that leave you for your next ETF trade? Well, I really do think you can count on these 3 rules of thumb. The first one is always use a limit order. That's the ABS breaking for your ETF trading. You should understand your cost, you should understand the spread, but fundamentally, put in a price that you're willing to accept. That's what the limit order lets you do. Second, think about the when and the why of your trade. Do you really need to be trading at 9:35 in the morning when the market's still frothy? Do you even need to be trading today if the market's particularly volatile? Understanding why you're trading when you're trading can go a long way towards avoiding an unpleasant time of the market. And then last, have some sense of fair value, whether you're using ENAV for a fund where that makes sense, or whether you're just doing the homework to understand why a particular fund might be trading up or down relative to the rest of the market. Having a sense of fair value is really all you need to know whether the price you're getting is a good price. That's going to wrap it up for the very basics of ETF trading. Thank you for listening. We'll see you the next time.